Starbucks is a coffee house chain based in Seattle, United States. It is the largest coffee house company in the world, but now Starbucks is acting more like a bank when you look at how the company's prepaid gift card and mobile app business. The idea that you could one day open a bank account at the same time as ordering your pumpkin spice latte seems a little less far-fetched, stereotyped, and bullied as it may be. Starbucks is your only Instagrammable go-to quick coffee shop, almost entirely in a league of its own. However, from a purely financial standpoint, Starbucks is also your favorite bank, whether you know it or not. Starbucks customers have lent the company over $1.6 billion USD. They are also competing, pretty favorably, with PayPal and other major US banks. So how, behind all of our backs, did Starbucks come to dominate the technology and financial sectors while simultaneously serving great coffee? Instead of paying with cash, credit, or debit card, you can also add money to your Starbucks account. Then, you can pay with the app on your smartphone, giving you twice the amount stars, which in turn lets you redeem free drinks. The app also lets you pre-order your drinks, customize them, and pick them up without entering a lineup. Sounds pretty standard, right? At first glance, the idea of the app doesn't seem too revolutionary. However, the Starbucks app is the most popular restaurant rewards app by a large margin, allowing it to do what others can't. Because of its size and customer loyalty, most people are not afraid to keep decent chunks of their money in their Starbucks account, knowing that eventually it'll be used. 41% of US and Canadian users pay with their Starbucks card. At the end of 2019, users held a collective $1.5 billion in balances. To put that into perspective, 85% of all US banks have less than $1 billion in total assets. Of course, customers will eventually exchange this money for coffee, but until then, they are unknowingly and effectively providing Starbucks with a $1.5 billion loan at 0% interest. This is money that Starbucks could simply reinvest into the market, earning free money from the generosity of its users, or potentially using it to open up new stores. Oh, and don't forget about the fact that about 10% of this money will be either forgotten, lost, or never used, known in the industry as breakage. But here's the thing, Starbucks is not a bank. Legally speaking, the Starbucks rewards balance cannot be withdrawn for cold, hard cash. This allows it to bypass financial regulations and use deposited money however it likes. It does not, for example, have to keep a certain amount of cash ready on hand in case of mass withdrawals. If it wanted to, Starbucks has all the tools and facets to form its own fully fledged currency, or partner with other brands to create a widely available mobile payment system. All of this is pretty scary to regular banks. The CEO of South Korea's third largest financial group was quoted calling Starbucks an unregulated bank, not a mere coffee company. Yet, even if all of the pieces are theoretically in place, Starbucks couldn't become a bank overnight. Banks are heavily regulated entities, and even Capital One, as a registered bank and bank holding company, is limited to the transactions it can conduct in its cafes. According to the company's fiscal year 2019 annual report, the majority of stored value cards are redeemed within 1 year and have no expiration dates in most markets. If Starbucks had a capital ratio requirement, would the short maturity factor force the company to have a majority of its cash on hand at all times? It's far from certain. That said, Starbucks' annual report goes on to say that when the company determines that prepaid card redemptions are unlikely, and there is no requirement for remitting balances to certain government agencies, those unredeemed card balances may turn into breakage income in fiscal 2019, 2018, and 2017. Starbucks, according to its annual report, recognized breakage income of $125 million, $155.9 million, and $104.6 million, respectively. That's plenty of capital when you consider that most startup banks raise just $20 million to $30 million in capital to launch. Who knows what's next? The idea of large companies looking to enter the financial services realm isn't new, but if Starbucks were to move forward with such an initiative, it'd make banking look very different from what it is today. You can already open up bank accounts from the comfort of your home. Why shouldn't you be able to do it while ordering a cup of coffee? Starbucks grew in popularity during the 1990s, early 2000s, and later on it recognized the growth of the internet and the popularity of social media, where people began posting their daily live activities, and thus needed something to post. There came a need for a casual space where people could congregate with good coffee, snacks, and ample Wi-Fi. Starbucks grew rapidly also due to its consistency and excellent branding. Along with those factors, Starbucks was strangely good at scouting new locations for their stores, so much so that a new term was coined in real estate, the Frappuccino effect. The Frappuccino effect, a significant increase in nearby real estate prices when a new Starbucks location opens. According to the ex-CEO of Zillow, Spencer Rascoff, in the time a normal home has appreciated in value by 65%, one nearest Starbucks location will appreciate by 96%. It seems as though Starbucks had the curious ability to find up-and-coming neighborhoods before the rest of the market. So, all in all, even in the midst of all the mocking and scrutiny, you'd be hard-pressed to claim that Starbucks hasn't been keeping up with the times. A Starbucks gift card is currently considered an almost liquid universal intermediary, and a versatile gift for someone you don't know too well but don't want to give the too impersonal gift of cash. It is impossible to say what the company will do next, or what its plans are for the near future, but almost anyone can agree that their financial redemption arc has been entertaining to watch among the industry.